Ladies and gentlemen, welcome to Finance World Histry. Right now, the silver market is facing a simple but powerful question. What happens when contractual demand is multiple times larger than immediately deliverable supply? We are heading into first notice day with roughly 88 million ounces of registered silver backing as much as 529 million ounces of open interest. That's more than a headline. That's leverage quantified. This is not about fear. It's not about speculation. It's about arithmetic. Because in futures markets, stability is not determined by opinions. It's determined by settlement. Over the next 72 hours, we move from theory to verification. Delivery notices will tell us exactly how much of that open interest converts into physical demand. Tonight, we're breaking down the math, the inventory trend, the delivery behavior shift, and the structural implications. No hype, no emotion, just numbers, mechanics, and market structure. Let's get into it. Step back for a moment and consider what a 6-to-1 leverage ratio really means in a physical commodity market. COMEX registered silver currently stands near 88 million ounces, while March open interest represents as much as 529 million ounces of notional exposure. That is not a small imbalance, though it is a structural feature of how futures markets operate. But when leverage reaches this scale, the important question is not whether it exists. The question is how sensitive the system becomes to changes in participant behavior. In futures markets, open interest reflects outstanding contracts, not guaranteed delivery demand. Each silver contract represents 5,000 ounces. When open interest reaches roughly 105,800 contracts, the total exposure equates to 529 million ounces. Against that, registered inventory, the category specifically warrant attached and available for delivery, represents the immediately deliverable supply. Dividing 529 million by 88 million produces a ratio just above 6.1. That means for every ounce available for delivery, there are 6 ounces of contractual claims tied to the exchange. Now, this structure is not abnormal. Commodity exchanges are designed to function on fractional physical backing, because most participants are hedgers, speculators, or arbitrage desks, managing price risk rather than seeking truckloads of metal. Historically, only a small percentage of open interest converts into delivery notices. That behavioral pattern is what makes the leverage sustainable. But leverage always introduces conditional risk. The higher the paper-to-registered ratio, the more dependent the system becomes on predictable rollover behavior. If the majority of market participants continue to roll forward or offset positions before first notice day, the 6-1 ratio remains a theoretical construct rather than a physical stress point. However, if even a modestly higher percentage elects to stand for delivery, the leverage begins to matter in a tangible way. The sensitivity is mathematical. At a 6-1 ratio, every incremental percentage shift in delivery demand has amplified consequences for registered stock. A 5% change in participation is not marginal. It can represent tens of millions of ounces. That is why leverage ratios are not just abstract figures. They are indicators of how much flexibility exists inside the system. Another layer to consider is the distinction between registered and eligible inventory. Registered metal has a warrant attached and is ready for delivery. Eligible metal is stored in exchange-approved warehouses but not currently designated for delivery. In periods of stress, some eligible inventory can be converted into registered. That conversion capacity provides a buffer, but it is not unlimited and depends on owner willingness. So the real insight from the 88 million versus 529 million comparison is not that the exchange is automatically at risk. It is that the margin for behavioral deviation narrows as leverage expands. When paper exposure grows faster than deliverable supply, stability becomes increasingly reliant on confidence, liquidity, and historical norms holding steady. Markets rarely fail because of headline numbers alone. They become unstable when leverage meets unexpected demand for the underlying asset. A 6.1 ratio does not predict disruption, but it does increase the system's sensitivity to delivery participation. And in leveraged markets, sensitivity is where risk begins to surface. Here is the uncomfortable truth most market participants avoid. Stress points in financial systems are rarely emotional events. They are numerical thresholds. When we talk about a 17% delivery rate exhausting registered silver inventory, that is not a dramatic statement. It is a breakpoint derived directly from arithmetic. Start with the base figures. If open interest represents 529 million ounces and registered inventory stands near 86 to 88 million ounces heading into first notice day, the question becomes straightforward. What percentage of contract holders would need to demand delivery for registered supply to be fully absorbed? Divide available inventory by total open interest, and you arrive at roughly 16 to 17%. That percentage is the mechanical crossover point where contractual demand equals deliverable supply. Notice what this implies. The system does not require 50% of participants to demand metal. It does not require panic. It does not require a historic anomaly. It requires less than 1/5 of outstanding positions converting from financial exposure into physical settlement. In leveraged markets, that is what makes breakpoints important. They are often lower than intuition suggests. Now, historically, futures markets operate well below that threshold. Delivery participation in normal conditions tends to range in the mid-single digits to low double digits as a percentage of open interest. Most traders roll forward to maintain exposure or close positions before first notice. That behavioral consistency is what allows exchanges to function efficiently with high paper leverage relative to registered supply. However, once delivery rates begin trending higher, as recent months have indicated, the sensitivity increases rapidly. At 10%, the system absorbs demand but experiences inventory contraction. At 15%, inventories tighten meaningfully. At 17%, the math moves from tightness to exhaustion of registered stock. Each incremental percentage point beyond that widens the gap between immediate deliverable supply and contractual demand. What makes this dynamic compelling is that it is binary. Either contracts stand for delivery or they do not. Once first notice data is released, the calculation is definitive. If delivery notices correspond to 12% of open interest, the system adjusts but remains orderly. If they approach or exceed the 17% threshold, exchange mechanisms must activate to balance supply and demand, whether through eligible inventory conversion, cash settlement incentives, or accelerated rollover pressure. This is why the breakpoint is critical. It defines the zone where flexibility narrows. Exchanges are not passive actors. They have tools, rulebooks, and liquidity channels designed to prevent disorderly outcomes. But those tools operate within the boundaries of available metal and participant behavior. The arithmetic does not disappear simply because the exchange intervenes. It must be managed. In finance, the difference between stability and stress is often a small shift in participation. A few percentage points can represent tens of millions of ounces. When leverage is high, marginal behavior becomes magnified. The 17% figure is not a prediction of failure. It is a measurable threshold that clarifies how much deviation from historical norms the system can tolerate before structural pressure becomes unavoidable. If you want to understand whether a market is tightening, don't start with price. Start with inventory. Price can be influenced by sentiment, positioning, macro headlines, and algorithmic flows. Inventory, on the other hand, reflects something more tangible: available supply. And in this case, registered silver stocks have declined from approximately 167.7 million ounces in October 2025 to about 88.8 million ounces in February 2026. That is a reduction of nearly 79 million ounces in just 4 months, a 47% contraction in deliverable inventory. That magnitude of decline is not routine warehouse fluctuation. It represents a material shift in available metal designated for futures delivery. Registered inventory is not theoretical supply. It is warrant-attached metal that can immediately satisfy delivery notices. When that category falls by nearly half within one delivery cycle window, it alters the supply cushion that underpins the futures market. Now consider the pace. A drop of 78.9 million ounces over roughly 120 days averages more than 650,000 ounces per day. On certain individual days, withdrawals have exceeded 3 million ounces. That acceleration matters because trends in physical inventory are often nonlinear. When drawdowns begin to cluster, it suggests consistent allocation rather than random variation. The next question is not simply why inventory declined, but how it declined. Inventory can fall because metal is physically withdrawn from warehouses, because owners choose to reclassify from registered to eligible, or because deliveries are being fulfilled at elevated rates. Regardless of the mechanism, the result is the same. The immediately deliverable pool shrinks. And in a leveraged futures structure, the size of that pool determines how much delivery demand can be absorbed without friction. What makes the 47% figure particularly relevant is timing. The reduction occurred ahead of a major delivery month. March historically carries substantial open interest. Entering that month with nearly half the registered supply compared to the prior quarter compresses flexibility. Even if delivery rates remain within manageable ranges, the buffer is thinner. Inventory contraction also influences market psychology. Lease rates, spreads, and term structure often respond to visible stock changes. When participants observe sustained drawdowns, expectations adjust. Hedgers may seek earlier allocation. Traders may price higher carry costs. Risk managers may reevaluate exposure relative to physical backing. Inventory trends feed directly into liquidity expectations. It is also important to contextualize this decline relative to annual delivery volume. If total 2025 deliveries exceeded 474 million ounces, more than double 2024 levels, and registered stocks are simultaneously falling, the connection becomes difficult to ignore. Persistent delivery activity combined with declining registered supply tightens a system incrementally. This does not automatically imply shortage. Exchanges can convert eligible inventory into registered, and warehouses still hold additional metal beyond the registered category. But the pace and scale of this drawdown signal a shift in balance. When nearly half of deliverable inventory disappears within a single quarter, it deserves attention not because of rhetoric, but because supply elasticity becomes more limited as the base shrinks. Markets reveal their true character not when prices move, but when behavior changes. And in the silver futures market, delivery behavior has shifted in a way that deserves close financial attention. January 2026 recorded approximately 49.4 million ounces delivered. To understand why that matters, compare it to prior years. January 2024 saw roughly 6.8 million ounces delivered, and January 2025 saw about 11.8 million. Moving from single-digit millions to nearly 50 million ounces in the same calendar month is not a marginal increase. It is a structural escalation in physical demand through the exchange mechanism. That kind of acceleration raises an important question. Are participants increasingly using the futures market as a channel for physical acquisition rather than purely for price exposure? Futures contracts are traditionally instruments for hedging and speculation. Most positions are rolled forward before delivery. When delivery volumes surge relative to historical norms, it suggests a higher proportion of longs are choosing allocation over rollover. February 2026 adds another layer to this behavioral shift. Approximately 18.7 million ounces were delivered from an open interest base of about 19.1 million ounces, implying nearly 98% of contracts stood for delivery. While February is not typically a major delivery month, the intensity of participation stands out. A delivery rate near full conversion is unusual in a system where financial settlement is the norm. Now, context matters. February open interest was smaller than March, and small base effects can exaggerate percentages. But even adjusting for scale, the pattern remains. Delivery participation is trending higher. When consecutive months show elevated conversion from open interest into physical settlement, it signals changing incentives. Why would that shift occur? Several possibilities exist within a financial framework. Participants may be seeking secure physical allocation ahead of anticipated tightening in major delivery months. Industrial users may prefer earlier acquisition to avoid future volatility. Institutional players may be reallocating from paper exposure into vaulted metal. The precise motive varies, but the observable result is measurable. More contracts are ending in delivery rather than rollover. From a systems perspective, rising delivery intensity interacts directly with registered inventory levels. High delivery months draw down available stocks unless offset by inflows or reclassification from eligible inventory. If sustained, that pattern reduces the buffer against future delivery cycles. It is also important to recognize the signaling effect. When market participants observe unusually high delivery percentages, expectations can shift. Others may accelerate their own allocation decisions, reinforcing the trend. Behavioral momentum in commodities markets can amplify supply-demand imbalances over short periods. None of this implies disorder. Exchanges are designed to facilitate delivery, but when minor months deliver multiples of their historical averages and approach near total participation rates, the market is communicating something clear. The preference for physical settlement has strengthened. In leveraged systems, shifts in behavior, even more than shifts in price, are often the earliest indicators that underlying conditions are evolving. There are moments in markets when speculation gives way to verification. First notice day is one of those moments. Up until that point, everything is positioning, probability, and expectation. Once delivery notices are issued, the data becomes definitive. Contracts either stand for delivery or they do not, and that single data release has the power to shift sentiment, liquidity, and price discovery in real time. Here's why this catalyst matters. Open interest represents potential demand. It is a pool of outstanding contracts, not a commitment to take metal. First notice day converts potential into declared intent. When the exchange publishes the number of delivery notices issued, that figure, multiplied by 5,000 ounces per silver contract, immediately quantifies physical demand. There is no ambiguity in the arithmetic. If 4,000 contracts are issued, that equates to 20 million ounces. If 10,000 contracts are issued, that represents 50 million ounces. The number is binary and mechanical. In a market currently holding roughly 86 to 88 million ounces of registered inventory, the difference between 4,000 and 15,000 notices is not marginal, it is structural. Financial markets respond most strongly to data that collapses uncertainty. Leading into first notice, traders debate participation rates, rollover behavior, and stress thresholds. Once the report prints, the market recalibrates instantly. Lease rates, spreads between spot and futures, and intraday volatility can all react within minutes because the delivery figure directly informs how much inventory will be drawn down. The significance of this event is amplified when leverage is elevated. With open interest potentially representing 6 times registered supply, the delivery percentage determines whether inventories decline modestly or compress rapidly. A low issuance figure signals continuity. A higher than expected number compresses the supply cushion and forces participants to reassess forward risk. Another factor to consider is signaling beyond the initial number. The first notice figure does not merely determine current month settlement, it shapes expectations for subsequent contracts. If March delivery participation is heavy, attention shifts immediately to May. Market participants begin evaluating how much registered inventory will remain after March allocations are fulfilled. The next delivery cycle effectively starts the same day the current one begins. Institutional desks monitor this data closely because it affects funding conditions and hedging costs. Elevated delivery participation can tighten physical lending markets, pushing lease rates higher. That in turn influences forward pricing, cost of carry calculations, and arbitrage spreads. A single data release can ripple across multiple layers of market structure. What makes first notice day particularly compelling is that it transforms narrative into evidence. Prior inventory drawdowns, elevated January deliveries, and February participation rates all build context. But the delivery notice report provides the immediate test. It tells the market, in exact contract counts, how much of the open interest has converted into physical demand. In a leveraged commodity system, clarity around that conversion is often the most important data point of the month. When leverage is elevated and inventory is finite, outcomes are not determined by narrative. They are determined by participation rates. The entire dynamic surrounding March silver delivery reduces to a single variable: what percentage of open interest elects to stand for physical settlement. That percentage dictates whether the market experiences routine rollover, measurable strain, or structural adjustment. Consider the mechanics carefully. If delivery participation remains within historical norms, say in the mid-single digits to low teens, the exchange processes allocations in an orderly fashion. Registered inventory declines but remains comfortably above zero. Liquidity providers continue operating normally. The forward curve adjusts modestly. In that environment, the 6.1 paper-to-registered ratio remains a background statistic rather than an immediate constraint. Now shift the dial slightly higher. If participation rises into the 20 to 30% range, the effect becomes nonlinear. At those levels, tens of millions of ounces move from theoretical exposure into actual allocation. Registered stocks contract sharply. Market participants begin recalculating the buffer available for the next delivery month. Lease rates may firm as borrowing demand increases. Spreads between spot and deferred contracts can widen as the cost of immediacy rises. The system still functions, but the margin for flexibility narrows. push participation further, and structural mechanisms become central. Exchanges are not static institutions. They have tools designed to preserve orderly markets. Eligible inventory can be converted to registered if owners choose. Cash settlement incentives can be offered to reduce physical claims. Margin requirements can be adjusted to moderate speculative positioning. These are not extraordinary measures. They are embedded within exchange rulebooks precisely for moments of stress. The critical insight is that high delivery participation does not automatically equal failure. It forces adaptation. If demand exceeds immediately available registered supply, the exchange's response determines how equilibrium is restored. That adjustment can take the form of price repricing, inventory conversion, or negotiated settlement. Each pathway carries implications for volatility and credibility, but none exist outside the established framework of commodity market operations. At the extreme end of participation, approaching half of open interest, the arithmetic becomes more demanding. The gap between contractual demand and registered supply widens materially. In that scenario, price becomes the balancing mechanism. Higher prices incentivize holders of eligible inventory to convert and deliver. Higher prices also discourage marginal demand. Markets clear through repricing long before they reach mathematical impossibility. What ultimately matters is not whether delivery participation increases, but how far it increases relative to available flexibility. A modest rise tightens conditions. A substantial rise compresses inventory and elevates volatility. An extreme rise forces structural adjustment. In leveraged systems, incremental shifts in behavior can have outsized effects, and participation rate becomes the fulcrum on which stability balances. Ladies and gentlemen, markets reward preparation, not reaction. We've walked through the leverage ratio, the inventory contraction, the delivery participation trends, and the mechanical thresholds that matter. Now the next step is simple. Watch the data. First notice day will provide clarity. The number of contracts standing for delivery will define the tone of this cycle. Whatever the outcome, approach it with discipline. Understand the structure, respect the math, and make decisions based on verified information, not noise. If you value analysis grounded in financial mechanics, this is Finance World Histry, where we break down markets with logic, not headlines. Stay informed, stay rational. I'll see you in the next update.